Hello, and welcome to today's Center for Audit Quality webcast entitled PCAOB Insights on Smaller Firm Inspections. I'm Cindy Fernelli, Executive Director of the Center for Audit Quality, and I'll be your moderator for today's program. The Center for Audit Quality, or CAQ, is an autonomous public policy organization serving investors, public company auditors, and the capital markets. Our mission is to foster confidence in the audit process and to aid investors in the markets by advancing constructive suggestions for change rooted in the profession's core values of integrity, objectivity, honesty, and trust. Based in Washington, D.C., the CAQ is affiliated with the American Institute of Certified Public Accountants. CAQ membership makes a powerful statement about your firm's dedication to quality audits, so I encourage you to join today if you're not already a member and become part of a group of approximately 800 member firms. We serve as the voice of the profession for public company auditing, representing firms of all sizes. We work to educate and inform member firms on issues that impact their public company audit practice in a variety of ways, including our technical alerts, the members-only section of our website, and through a host of other activities and events, such as today's webcast. As part of our mission of enhancing audit quality, we provide resources to member firms that are educational and useful to them in improving or maintaining the quality of their public company audit practices. They include our website's Inspection Readiness resource page. To find that resource and information about the benefits of CAQ membership in general, visit our website at www.thecaq.org and click on Members. Now, before I introduce our featured speakers and jump into today's program, there are a couple of brief housekeeping matters that I need to cover with you. First, we'll be taking your questions during today's program. To submit a question, you'll see a question field in the lower portion of your screen. Just type in the question and click on the link labeled Send Question. We'll stop at certain times and address the questions during the webcast. Second, the revised CPE standards require us to take attendance during the webcast to verify participation. Please note that there have been some significant changes to the CPE rules. Twice during today's program, you will be given and asked to write down a unique CPE program code, each beginning with the word ALL. Once I give you each of the codes randomly during each hour of the program, you should immediately write it down and keep it with today's program materials. This is something everyone wanting CPE credit today needs to do. Additionally, for those of you claiming CPE credit in California, it does get a bit more complicated. What I'm about to go over applies only to California CPAs. The new California CPE rules require you to have 3 additional interactions with us during each hour of today's program. These additional interactions will take the form of a pop-up window that will appear in the PowerPoint slide window of your screen. When you see the pop-up, you should immediately click on it to register your interaction with us. So, California CPAs need to write down the 2 CPE program codes that I'll give out during the program, plus click on the 6 additional pop-ups that will appear during today's program. Later in the program, I'll tell everyone how to use the information that you get to document your CPE credit. Now, on to today's program. On October 22, 2007, the Public Company Accounting Oversight Board released a report on issues identified in the 2004, 2005, and 2006 inspections of U.S. firms that audited 100 or fewer public companies and that are triennially inspected. This report was issued under the PCAOB's Rule 4010 and does not identify any particular firm or firms. The PCAOB's report includes observations in 11 areas where auditing or quality control deficiencies were observed, including areas such as revenue, related party transactions, equity transactions, use of other auditors, independence, and concurring partner review. The inspection process results in a range of observations that help firms identify areas where improvements can be made for benefit of our nation's investors. However, and this is an important point, the PCAOB makes clear that its report is meant to provide useful information, but not draw broad conclusions about the quality of audits performed by any particular firm. Today's interactive CAQ webcast is an opportunity to hear from and ask questions of the PCAOB about the most common deficiencies noted during inspections of smaller firms. Our guest panelists will identify each of the problem areas, including the risks associated with these areas. In addition, they will also discuss the general responsibilities of the auditor and the inspector's observations of those audit deficiencies. Lastly, our auditor panelists will provide you with their unique perspectives on how to overcome some of the challenges of auditing a smaller public company. Today's program is designed to specifically address the basis used to develop the PCAOB's 4010 report on domestic triennially inspected firms, the 11 audit areas where significant or frequent auditing or quality control deficiencies were observed, the general responsibilities of the auditor, and common inspection observations. We do have a great deal to cover today, and to help us gain a better understanding, we have put together a terrific panel of experts. So let me take a moment to introduce each of them. First, I'd like to introduce Mark West. Mark is Regional Associate Director of Inspections and is also the Small Firm National Coordinator with the PCAOB in Denver, Colorado. Mark started his career in public accounting with a large firm in their Kansas City office. Throughout his career as auditor, Mark served on various audit-related committees, serving as chairman of the Kansas Society of CPAs Peer Review Committee and as part of the AICPA's Peer Review Committee, including being a team captain on numerous peer reviews for over 10 years. Mark, we're very pleased that you could join us today.
Thank you, Cindy.
Next, we have Joanne Wagner. Joanne is a CPA and a partner in charge of quality assurance for Blackman Kallick. She specializes in accounting, auditing, ethics, professional responsibility, and quality control issues. As part of her responsibilities at Blackman Kallick, Joanne oversees the quality assurance controls over the firm's accounting and auditing practice. This responsibility encompasses consultations with engagement teams on accounting and reporting issues, along with pre-issuance review of over 500 client financial statements annually. She also is responsible for the firm's auditing policies, procedures, and practice aids through the supervision of the firm's Director of Auditing. She consults with firm management regarding the quality assurance aspects of strategic firm issues and decisions. In addition to her regular job, we are pleased that Joanne serves on the Center for Audit Quality's Professional Practice Executive Committee. Joanne, welcome to you today.
Thank you, Cindy.
And last but not least, we have Curtis Wolf. Curtis is a CPA and principal in charge of audit and assurance at Resnick Group. In that role, Curtis guides the firm's focus on independence, objectivity, and integrity. Recognizing the impact of risk management and quality and compliance on client service and firm profitability, Curtis implemented significant organizational and procedural changes in the firm, including modifying the organizational structure. He introduced policies and procedures related to clients' acceptance and continuance, engagement performance, consultation and quality reviews, and firm-wide risk management. Curtis also serves as a volunteer on one of the Center for Audit Quality committees, the SEC Regulations Committee. And Curtis, it's a pleasure to have you here.
Thanks, Cindy.
Now, let me kick things off a bit by asking our guests to react to a couple of questions. Based on your own experience and perspectives, do you believe that audit quality for auditors of public companies has improved over the last 3 years, and why? And first, I'll turn to our regulator, Mark, and ask him to answer that question.
Thanks, Cindy. Well, I suppose a couple of things come to mind when I think about the improvement of audit quality, particularly in the last 3 years. The one thing I think that has had a big impact is the involvement of audit committees, both involved from the standpoint of their interaction with the auditors as well as the review of accounting policies that the issuer has. I think that's really caused the firms to focus a little bit more on the audit quality. and improve that. The second thing, although it's very early in the remediation process, particularly for small firms that have just been inspected once every 3 years, those that have undergone remediation, there have been some really good steps to improve audit quality. Obviously, the proof is going to be, can they execute those changes? But I was very encouraged by the remediation that was done by many of the firms.
Great. Well, thank you for that. And Joanne, what's your perspective? Being an auditor, being out there, what do you think about audit quality over the last couple of years?
Well, I agree with Mark that it has improved over the last 3 years. First and foremost, I sense that the profession has renewed its commitment to auditing in a big way over the past few years. Secondly, having a regulator looking over your shoulder really gives you that extra bit of energy that you need when the going gets tough out there on the audit trail. And so that certainly has been a tremendous amount of help to us. Lastly, I think the audit quality has also benefited from the activation of management and they're taking responsibility for the financial statements. Many companies are investing money in their financial infrastructure, such as improved financial reporting systems, and they are expanding their financial staff, so they're looking to outside sources to give them some assistance that they need in getting their basic accounting stuff taken care of. As Mark was saying, the audit committees are certainly providing support and encouragement to management in this endeavor. And it is much easier to complete a quality audit when the controls are effective and when the client isn't making mistakes.
Curtis, what's your perspective on that question about audit quality?
I certainly agree. There's no question that it's improved. I think, as the others have said, it's not just the inspection process that's getting it done. I think the integrated audit approach under AS2 and now under AS5 has made a big difference. I think a better understanding of the financial reporting process, the nature of the transactions, just improves the overall audit quality. And I think we'll see that more as we move to the non-accelerated filers, for the smaller firms. But there's no question, that discipline that comes with the regulators looking over your shoulder, it forces some behavior that's appropriate.
A little added extra there.
That's right.
Huh? Well, we're going to spend a good portion of our afternoon talking about the PCAOB's inspections findings. But for those of our viewers who have not yet gone through the inspection process, I'd be curious, Joanne and Curtis, if you could tell us what to expect if you've not gone through that. And as you do that, if you take a moment to explain a little bit about your firm. So let's start with Curtis and talking about the Resnick Group.
Sure. First of all, Resnick Group is one of the top 20 accounting firms in the U.S. We've got 10 strategic locations, and we have approximately 60 issuer clients. Our inspection was in 2006, and the firm's background, we have a pretty diverse client base, but we are concentrated on real estate, and we are absolutely dominant in the affordable housing real estate market. So I'll give you some idea what Resnick Group is about. I would say, as far as preparing for this, one thing that we did was we went to an outside resource, and these folks are available. And that is, we went to a retired Big Four partner and invited him in to take a look at our engagements on a selective basis and got some feedback. So someone like that that's had the years of experience in that market, it's a bit of a triage, if you will, to see what kind of issues you think you might have and can work on improvement. I mean, the whole idea about this process is a chance to improve. So that's one way that I would prepare. The other is I would give some consideration. What I think is improving in the quality is this sort of systemic look that is coming out of the process. Some matters that we're going to talk about today, like independence, are getting a much better look in these smaller firms. And that is one of the areas where Resnick Group had to put some focus on its affiliated entities, contractor relationships, other auditor relationships that we really needed to address. So you need to think outside of just the engagement exposure that you're going to have through this process.
And Joanne, what would be your advice to somebody facing an inspection for the first time? And tell us a little bit about Blackman Callick, too.
Oh, sure thing. Blackman Callick has its one office in Chicago, Illinois. We're in the top 50 firms. We have approximately 200 employees. We predominantly serve the middle market. We have approximately 8 issuer clients, and our first inspection was in 2005. So we are up in 2008. My recommendation really for inspection readiness is for engagements teams to really work that planning session for their audit engagements this year, and really be sure to tie in the results of that planning session into the work that is actually done in the field later on. One of the things to think of in that planning session is to think through some of those high-risk areas that exist and whether or not the audit procedures that they're designing are really going to properly address those high-risk areas. A very important part of that risk assessment is to focus on what has changed for the client and what unusual transactions they've entered into. For instance, is there a new stream of revenue that has come to the company this year? Have they made an acquisition? What are the motivations of the company and the staff of the client this year? Are their profits somewhat marginal this year, but yet there's a big bonus plan in play, or stock options going to expire? Are they going to issue more equity this year? There's lots of things that go into the thought process of what might be an audit procedure that is going to be responsive to a lot of these situations that might be popping up. The team procedures may need to be significantly updated from year to year in order to reflect them. Just repeating the prior year audit plan is dangerous, actually, to an ongoing audit. It's also dangerous to a satisfying inspection and experience also down the road, too. And then once the team has put that excellent plan together, it needs to implement that excellent plan also. It's so easy to get trapped in your practice aids. So that if you plan to make some changes in those audit procedures for this upcoming audit, you need to kind of get that worked into the practice aids so you have a really excellent opportunity to get those changes made. So I would really recommend focusing on the planning and execution of the plan and getting ready for inspection.
Well, that's a good general overview. We do have a lot to cover today. So let's begin by turning to Mark. And for all of you that are listening in and can see the slides, go to slide number 6. That's where we'll start. Before we dive in, I know Mark has something that he has to share with us.
Yeah, obviously every time we do these, we have to give this caveat that the views that I express today are mine alone. They don't necessarily express the views of the board, individual board members, or other staff of the PCAOB. Having said that, now we can turn to the next slide and get started really with the program.
I don't know, Curtis and Joanne, do you want to give a caveat too? Or
Ditto here.
Similar observations, but it will be the only view of Resnick expressed today. So.
Very good.
All right, on slide 7, we're going to talk about the overview. Cindy already mentioned that what we're going to talk about is that 4010 report that we issued basically with the results of the 2004, 2005, and 2006 inspections of the small firms. And I'll kind of give an overview of what the makeup of that group is a little bit later. We're also going to talk about the 11 issues that we identified that were either engagement deficiencies or quality control perceived deficiencies. We'll talk about the auditor responsibility related to those, and then talk about the issues that we ran into during the process. Kind of some small firm statistics. There are about 1,000 domestic firms registered with the PCAOB. Of that, there's about 650 that actually do audits of publicly held companies on a normal basis. So those are the 650 firms that are subject to inspection. They are geographically dispersed throughout the country, and they vary in size from very small single partner firms, one owner, one issuer, to numerous partners. My own firm had about 220 partners, 20-some offices, but they did less than 100 issuer audits, so they're defined as a small firm as far as the PCAOB is concerned. So it varies in size. The issuer base varies from very complex companies to shell companies with really no operations. We've performed about 500 inspections in 2004, 5, and 6. Approximately 62% of those firms had 5 or fewer issuer audit clients. Only about 10% of those firms had more than 26 issuer audit clients. During those inspection process, we've covered parts of issuer engagements of about 1,600 issuer clients. There's been about, and this is on slide 9, you got to keep reminding me to tell them when to flip slides, but on slide 9 it talks about We've issued reports on about 450 of those inspections as final to date. About 248 of those reports identified at least one engagement deficiency and quality control deficiencies. So we issued this 4010 report describing deficiencies that the board thought warranted emphasis in the general public, although I believe that, in my mind, most of the people that are going to find benefit from this report are really firms that do audits of publicly held companies, and to some degree the issuers of small public companies as well.
Mark, before we move on to the next slide and talk about some of the findings that are in the 4010 report, we do have a question from one of our audience members asking about a draft inspection report that they had received on their own firm audit that differed in both tone and conclusion from the inspection team's exit interview. Can you tell us why that might happen, or if that's a common occurrence, or what might lead to that?
Sure. I don't really think it should be a common occurrence, but during the inspection itself, there are comment forms that we issued, much like the old MFCs that you found in the peer review process. But those comment forms are issued. We try to agree to the facts with the firm prior to the time that we leave the field to make sure that the factual situation related to the comment forms we all agree upon. And then there's conclusions that we reach based on those comment forms. Then there is a significant review process that goes through both at the regional level and nationally, where we review those draft reports that are prepared by the engagement team, and there's changes that are made throughout that process. So we try and make the reports as consistent as possible by making sure that it's reviewed both at the regional level and nationally. So if the tone changed, maybe it's partly because we want to have the same tone in the reports throughout the country.
So that consistency factor.
I know it was made very clear in our inspection process that it's not over until it's over, I guess is the way I would put it, that there was quite a review process that was taking place.
There is. And for the final reports, it's in addition to the inspection side that review it, we also have the standards group that reviews every final inspection report, and general counsel also reviews. So there is a very extensive review process that the reports go through.
Well, and I also think the format of the reports itself is something that's been hammered out in the legal offices everywhere else. So you're going to see in the final report a very huge similarity in the structure and the words used, other than the specific findings. So I think that's just forced by the nature of the report that needs to go out.
Joanne's right.
Okay.
There is some very standard language in a lot of those reports. That we tailor them, obviously, for the individual circumstances that were identified during the inspection for that particular firm, but there's a fair amount of the report that is standard language from report to report.
Okay, great. Well, so are you ready to share with us what some of the findings
Sure.
were on the 4010 report? Slide 10.
I was just going to say, as noted on slide 10. We've got a number of issues. It's not a top 10 list since there's 11 of them, and I don't want anybody to think that they're ranked in any sort of order. These are just areas that we've identified that had common occurrences that we think are really good to discuss with everybody. So we're going to cover things like revenue, related party transactions. Well, you can read the list. I don't need to go through those, and we'll go ahead and move into the individual ones on the next slide. The first slide that we're going to talk about is revenue, and probably this is one of the areas that we see more frequently inspection findings related to revenue. There's a number of reasons for that. I think probably complexity of the area drives that, but probably also the audit approach that many firms use may also drive some of those inspection findings. First, the general responsibilities that the auditor has basically is to test the existence, completeness, and valuation of revenue. And second, they also need to make sure that the timing that revenue is recorded is proper, and that's probably the area that most of the problems come about. If you look at this first bullet, it talks about the inappropriate use or reliance on testing accounts receivable and inventory. That's probably a broader issue than what it really indicates here in this bullet. Most small firms use what I call a balance sheet approach to the audit. They spend significant amount of time auditing a balance sheet and far less time auditing the income statement. They'll use analytical reviews to make sure that items on the income statement are properly classified, but other than that, they feel like net income's got to be right since the balance sheet is right. In some cases, that may be appropriate if you do some cutoff tests of revenue, but in other cases, it's not necessarily the right answer because of revenue recognition issues that relate to that particular revenue. We had examples where it just had to do with the timing of shipment. You recognize revenue based on FOB shipping point or destination. The issuer over the years had moved from their customers using FOB shipping point to FOB destination, and they moved to a lot of more overseas foreign types of sales, so that the difference between those two dates was a lot larger. But the firm did not go through and audit that and determine that the revenue recognized based on date of shipment was in fact proper. So there's lots of issues related to that, and we'll talk about some other issues, but I know that Joanne has some comments that she's come across in the audit of revenue in her client base as well.
Oh, absolutely. You know, it sort of, as I think about revenue recognition, it strikes me that one of the things that we need to audit is the revenue recognition policy itself, and pardon me, and whether or not it matches up well with the company's business. And one of the ways that we do it is, as Mark has said, is to look at the underlying contracts to see whether or not, if the revenue recognition policy matches up with the actual agreement that the client has with its customers. And for instance, you know, do you have a contract that is talking about the delivering of the primary product, and then all of a sudden there are some additional deliverables that need to go out, whereas the client is recognizing revenue when the primary product is delivered entirely. The contract itself is a key aspect of many aspects of auditing, because it serves as really a good documentation rather of the agreement that the client has with its customers. Now that contract itself doesn't necessarily have to be well written. We have come across situations where the contracts are bad, that some companies have decided to save a little bit of money on legal fees and pull a contract off of the internet and use that to document its contracts with its customers. And that can lead to other sorts of problems and other sorts of audit issues, and really some very significant problems for the company themselves as they try to get to the bottom of what the revenue recognition policy should be.
Curtis, what do you say with respect to this area on revenue?
Yeah, some thoughts on it. I know for the smaller firms, a fairly common audit methodology is, let's tackle the balance sheet, and then we'll do the analytic review. And I know we've had observations in our own practice where that substantive analytic review wasn't adequate, and it wasn't addressing all of the circumstances under which you have a sales transaction. So you weren't addressing all the assertions. The thing that concerns me the most here is the bundled transactions, what Joanne was referring to in the high-tech clients that we have, where they bundle a service with a product at the same time. It's very difficult to understand the economics of the transaction. If you can't get to the economics, you're likely to miss the appropriate accounting. So that's a challenge. I know there's EITF issues and interpretations to help you figure that out, but it is difficult. And in a high-tech industry, it changes constantly. So you're challenged with staying up with your client and understanding their business model. The other area where we spend a lot of our time is in the real estate industry, and it amazes me the number of variations on fees that folks can think of to generate revenues. So not only do you have the challenges of the estimates and percentage completion, but the fees that might be coming out in management fees or development fees or finder fees, syndication fees, whatever they might be, that's a very challenging area as well. You have to understand what your client is looking for, what the customer is paying for.
And the other aspect of balance sheet only auditing is, of course, it doesn't address some of the issues that have arisen over the last few years, such as in the presentation of gross revenue versus net revenue that EITF 9919 now takes care of for us. Mm-hmm. Now, that analysis can be kind of difficult and kind of subjective itself, but there are very significant issues that have arisen in that particular area that balance sheet auditing is not going to address properly.
As we move on to slide 12.
Well, I have just a little bit more to add on this one. I know Curtis really talked about the second and the fourth, and I don't mean to jump over you here, but the last bullet about the complex specialized revenue by industry, we've seen that in contractors on the percent of complete and firms not doing an adequate job at testing the estimated cost to complete, which is a big driver in computing revenue based on percent of complete. In the franchisor arena, we've also seen where they're recognizing revenue as they receive the franchise fees, but yet there's future services that are there. So, and you've also got the computer software, which you already talked about. But I think there's also, in the more simple types of transactions, I mean, I remember having an extruder, a plastics extruder manufacturer that they recorded revenue based on shipment date. Well, that was okay early on, but then they started doing things like guaranteeing a certain level of output. And then they started expanding their markets into foreign countries, and the electricity supply in those foreign countries was sporadic, and so they had to do a lot of work on the machines to make sure that it produced. So it took a long time after shipment before revenue really should be recognized. So it can be in the even common areas. So you really need to understand the issuer's revenue recognition policy. You really need to understand how they generate revenue before you can do a good job of auditing.
And it sounds like keeping current and reviewing that periodically to make sure things haven't changed. Okay, on to related party transactions on slide 12.
Okay, if you look at slide 12, it's interesting that on the first three bullets, we talk about identify and identify and identify. For related party transactions, that's probably the biggest issue that the small firms have to address. It is very difficult in small firms to really identify all of these transactions, and you need to do a little bit of work doing that. I also think in these small issuer clients, related party transactions are rampant. I mean, there's just lots of them. I think it's due to the nature of the beast. There's a lot of interaction between their board members and others. Other board members have other businesses that they interact with. And so it's really difficult sometimes to go through and identify all of those related party transactions, which is the biggest key. Obviously, the disclosure of those is important, and also making sure that the amounts that have been disclosed are proper. So, but identifying them first is the main problem. And so, again, you have to really understand the nature of your issuer client. Where do they have their sales? Where do they get their products that they sell? Where do they get their banking? Is there any relationships there that would be related party types of transactions? Plus, you look for types of transactions that would indicate that they're related parties. Interest-free loans, terms on sales that are extended and unusual. So that can help you also identify related party transactions. But identify is the biggest issue, I think, with small firms.
Well, it is. And one thing to look for as we're going through is, like, transactions have to make sense. So if you come across a transaction that doesn't make sense, you know, one of the likely outcomes is that a related party is involved, especially in the smaller business clients that are out there. The why question is a big question that should come up when you're hunting for the related party. Why is this transaction structured the way it is? Why did we get a loan at prime -2 when we're on the verge of bankruptcy? Why? And so forth and so on. Why are we selling product at zero profit? Or why are we selling product at excessive profit? So it can work both ways. But another thing it never hurts to do is to get very familiar with the names of all the key players at the clients, because sometimes when just doing a little test a transaction here and there, you're going to stumble across one. It happens.
Curtis?
Some observations. I agree with Mark. The smaller firms seem to deal more with the related party issue than I think the larger firms. That's my prior background as a former Big Four partner, and my public clients, my issuer clients, had virtually no related party transactions. They were effectively prohibited. But yet in the clients that we serve today at Resonant Group, many of them have related party transactions. You couple that with the focus that we have on the real estate industry, and we see all types of related party transactions. It's just the nature of the industry and how it's structured. You know, you hear it all the time. You have to understand the industry that you're practicing in. And this is influenced, there's absolutely no question about it, by the industry. But it's taking that time, as Joanne's mentioned a couple of times now around planning. You have to get to know what the entity, what management's involved with, who the affiliates might be, and where the transactions might be out there. Because it seems to me that once they're identified, we've got a pretty good understanding of what it takes to disclose them.
Right.
So let's move on to equity transactions,
Okay.
unless you want to finish
Well,
one
there
last
was
thought
one more.
on the related party.
In listening to Joanne talk, it made me think of one more thing, and that is we did run into, on occasion, some unusual transactions where there was significant amounts of revenue, i.e. net income, that was recognized. And when you really peek behind the curtain, those were really related party transactions, and that wasn't identified as such. So if you've got some of those unusual transactions that generate a significant amount of either revenues or net income for the issuer, you may want to take a real hard look at that and make sure that that isn't a related party transaction.
And sometimes those things that are creating the profitability are not items that should be going through the income statement at all.
That's true.
They could be something like a forgiveness of, a receivable forgiveness of a payable that is in essence more of a deemed capital or contribution or a deemed dividend and needs to be pulled out of the income statement to show its true economic substance. And there can be these, when you're evaluating a collectability type issue, sometimes I think auditors might feel uncomfortable in pursuing questions of the personal net worth of the players involved or the viability of the related entities with whom the company is doing business, but yet the auditor is not auditing. And sometimes we feel like, oh, we're nosing into something that's not our business. But I think if an issuer or client has opened the door by entering into related party transactions, the door is open to the auditor also to step through and perform the audit procedures that need to be done on those entities and persons outside of the company.
You know, before we move on, Joanne, you just mentioned income statement testing, and we do have a question from one of our viewers wanting to know what should they be doing to audit the income statement? Should they be selecting hundreds of transactions? How should they go about doing that? Any insights?
Well,
Curtis?
I'll offer, I don't know about hundreds of transactions, but an analytic review in some of the scenarios that we've described just won't be adequate if you haven't taken some detailed test of transactions and observed just what is going on. This is where I think the integrated audit approach for the non-accelerated filers will add a lot of value. That if you'll just take that time in a walkthrough process of understanding the reporting of their transactions, there'll be a greater understanding. And then you can decide whether or not you need to be doing more tests of details, more tests of transactions as opposed to the analytic review.
And that varies so much based on the client. I mean, you can envision circumstances where 80% of the revenue is derived from 2 or 3 customers. Well, then you do the audit work related to those 2 or 3 contracts related to those customers, and you're adequately going to address revenue. You can also see where there could be very good substantive analytical types of procedures that were performed given the industry or something. If you can use some sort of output or machines produced or units produced or whatever, that you can generate good analytical tests to verify the revenue generated from that, there can be some very good substantive audit analytical review. The problem was we just didn't see a lot of that in many of the tests that we saw in revenue.
Yeah, a product with a solid history of a margin, you know, could be tested on an analytic review basis. However, the services associated with it might not be. Might be another way to approach it.
Very helpful. Equity transactions, slide 13.
Equity transactions. I think for a lot of the small issuers that are small firm client base audits, they use equity transactions almost like cash. They have very little cash available, so they issue stock for goods, for services, for just about anything, just to save their cash. So I think there's a lot more equity transactions in these small issuers than there really is in most of the large issuers, and probably more that are issued for not cash than for cash. So it becomes a valuation type of issue is the biggest problem that they have with equity transactions related to these small issuers. The SEC basically has a de facto or a safe harbor rule, if you will, using market value as the key for, or the thumbnail for valuing those securities, but that may not necessarily always be the right benchmark to be using. If that ends up with some ridiculous results because you're using market value because of the very minimal amount of trading that's going on with these small issuers and the volume of this particular transaction, you're going to have to, as an auditor, really look at the value of those other goods and services that were received to make sure that it makes sense. And also, if you're using stock option types of things, using some sort of model, you need to go through and evaluate the assumptions that are going to be used, volatility and those sorts of issues. And the last bullet really had to do with, we've seen cases where management, I'm going to say arbitrarily, set a value for these services. They used a 50% haircut, if you will, and said that the value of these was worth 50% of the trading value of the securities. They used $1 per share to set the value, or they used par value to set the value. And the audit firm did not go through and do any audit testing to determine that valuation was reasonable. So, Joanne, any discussion you have on that issue?
Yes, I think the safest thing to do is to default to market rate like the SEC has suggested. And if there is a case to be made that something else is appropriate, then by all means make it. On the equity side of things, the complications we've seen a couple of these pipe-type transactions, which are the private investment and public enterprise sort of debt stock derivative sort of combinations. And those, when those come in, those are arrangements that really need a very high level of scrutiny for both the identification of derivatives, the valuation of all the different component parts to them, and then the subsequent accounting. Most of our clients that get into those things, we suggest, and they certainly are most amenable to this, that we find an outside service that will assist them in getting all that taken care of, so that they can look at it and understand the accounting, and that we can follow along and audit it as need be in order to get that transaction properly reflected in the financial statements. But that's been the most difficult equity-type transaction that we have seen at this point.
What are your perspectives, Curtis?
Well, this might sound unbelievable, but we have issuer clients that have more equity transactions than they do sales transactions. It's absolutely the case, especially development stage companies. It occurs. Absolutely. And so that challenge is something that, you expect your lead engagement partner to absolutely understand the industry and the business, and the concurring partner should as well. But it may take a specialist beyond that within the firm. I understand, Joanne, you're referring to maybe an outside specialist to come in on the valuation issues and that sort of thing. But just even identifying those transactions and understanding, because we've got puts, we've got options, we've got warrants, we've got convertible debt and equity securities, the pipe transactions, beneficial conversion features and securities to be valued. These are very, very complex issues. Embedded derivatives you find in these transactions as well. Very complex, difficult to understand. And so you may need to sort of attach a technical expert sort of on the tail end of the engagement to make sure this gets caught and gets identified, and the proper accounting is addressed at the end of the day.
It never hurts to read the agreements. I like reading the agreements because, you never know on page 12A, 3C, that there's not going to be a little something there that comes back to bite you at some point.
Right.
One other thing that I want to add and make sure that probably heightened scrutiny as far as we're concerned, and I really think the auditor should have a heightened scrutiny on these sorts of transactions, is if they end up on the balance sheet. For example, they've acquired some sort of intangible via the issuance of stock, and so it ends up now on the balance sheet with a large value. I think the auditor needs to have a heightened scrutiny on the valuation of those intangibles because it's now sitting on the balance sheet. Certainly we'll look at that with more scrutiny than just transactions that flow through the income statement, because at the end of the day, if you book some common stock and then it is expensed as some sort of compensation or consulting expense, that's one thing. But if it's going to be on the balance sheet, you as an auditor better spend a little bit more time looking at that.
And for those emerging companies entering into those transactions, it is especially difficult because the stock is thinly traded.
Yes.
That market value that we use as the default, you worry about, especially when you're putting an intangible up on the books, because the intangible itself is,
It's hard to value, too.
It's hard to value.
So that valuation is much more subjective. Yes.
Well, let me ask a question about that. What if there is no market price or no readily available market price? What are the alternatives to use? I mean, that's certainly a question that's on a lot of people's minds today. Is any insights into that?
Well, it's the asset given up or the asset received.
Whichever more readily determinable.
Whatever, exactly. So
Sounds like appraisal to me.
Basically what they're saying is, since you can't value the stock, you have to then look to the other side. What goods or services did you receive, and go through and do your testing there. And that may be easier to do than trying to value this thinly traded or not traded at all common stock. So you really sometimes have to look to the other side. And that's not necessarily easy to do either, but it may be easier than trying to value the stock itself.
And I think that was your point earlier, Mark, when you said you might come up with some ridiculous value because you used a market value on the stock that just didn't make sense to the asset that you actually acquired.
Particularly because we've seen transactions where the actual trading of the stock is in the 100 shares, 1,000 shares, 10,000 shares, and then you have a transaction of 5 million shares. Well, it can come with some really strange answers if you use the market value of those. That $10,000 somebody put in the company to cover operating costs, and now we've recorded $10 million worth of some other transaction just because of the number of shares.
Well, before we move on to slide 14, I do need to jump in here and tell our viewers that we are getting ready to put up the first CPE code. So anyone who wants to claim CPE credit needs to write this code down and keep it with today's materials. So the code is ALL4PC56. That's ALL4PC56. And later in the broadcast, I'll tell you how to use this information to document your own CPE credit. So with that, let's move, Mark, on to slide 14 and talk about business combinations and impairment of assets.
All right. I'm probably going to not cover these bullet for bullet the way they're laid out here, but if you look at the general responsibilities, it talks about first you need to determine that the transaction has been accounted for properly. And what we're talking about there is, did you record it at the purchase price or fair market value price? Did you use historical cost? Was it a reverse merger? Whatever. And in order to determine, I think the first thing you have to do is get a copy of the agreement. We've seen in a number of inspections where there was a significant merger or business combination that went on, but they didn't even have a copy of the merger agreement. I don't know how you can audit that if you don't have a copy of the merger agreement. Second, once you have a copy of the agreement and you decide that this is a reverse merger or it is a business combination, should be accounted for at fair market value, then you have to go through and value the transaction. Well, first I think you need to identify the consideration that's being paid. So you got to go through the contract and figure out exactly what is being given up and exactly what is being received. We've seen a number of acquisitions where there was some contingent consideration. Well, I can't hardly speak here. Contingent consideration that wasn't properly accounted for because they didn't identify that as compensation for the acquisition. After you've determined what the consideration is, then you have to value that. And you have the same problem in these small issuers, particularly if they're issuing stock to make this business combination in the valuation. You got the whole issue that we just talked about, fair market valuing the assets given or assets received, whichever is more readily determinable. And again, in many cases, the stock that's issued for these business combination is huge in relation to what's been traded up to that point. So you got that whole issue. Then you have to take that purchase price and you have to allocate it to the assets. That has to be done in a particular manner. You need to make sure that that's done properly. And then finally, there's proper disclosure. The thing I probably want to point out that's probably the most troublesome, other than not getting a copy of the agreement, which I think is troublesome, but it's the valuation issue of those. And And keep in mind, in many cases in these business combinations, you end up, because they're valuing or using the market value of the stock, they're ending up with tremendous amounts of goodwill or other intangible assets that they're then setting up on the balance sheet. What we've seen in numerous cases is then at the end of the fiscal year, and this might be a week later, it might be a month later, it might be 6 months later, there's an impairment analysis that's done, and it's determined that this goodwill doesn't exist. And so it's been impaired. So if you got that case, maybe you need to go back and look at the purchase price valuation to begin with. So that's a major issue with these small issuers, because so many of these valuations are done with stock. And then you got the other issues Curtis was talking about, the different types of debentures or convertible bonds or whatever, the unique financing features that they're using to acquire these that also have to be accounted for.
Curtis, any additional observations?
I'm sure we'll say much of the same thing here. The way I look at it is a business combination is typically a very significant event in the life of a company. I think about the HR people talking about life events for you. Well, you should step back and think of this as a life event. It's not just another purchase sale transaction. There are all types of assets that get identified and recorded at this point in time that are never otherwise recorded on a historical cost basis. That takes a good deal of consideration, what those intangible assets, and more today than any other time, intangible assets are what's going to be recorded onto the balance sheet. So you need to give some consideration to that. You have to step back. You have to understand the transaction. And again, reference to the agreement, is it a stock acquisition? Is it a purchase of assets? Is it a business combination to begin with? Let's make sure we get there. But you need to educate your client early on as to the level of evidence that's going to be required to get through the process, that there's going to be a need for valuation, there's going to be a need for understanding, and that we need some time to get this done. And that's a pretty important point on the front end.
I have a question. We're talking about valuation in complex scenarios, and earlier we said that you might hire a specialist to help you through that. How do you evaluate the specialist if your firm doesn't have expertise itself? Any pointers on how that can be done and accomplished?
Well, the valuation industry right now is quite interesting. You know, there's a wide spectrum of quality of valuation shops out there. And it's actually something I think that's quite worrisome to the profession as a whole. And so it is especially critical to check the bona fides out of the valuation company that's being selected to make sure they're reputable. Sometimes the price tag alone is an indication of the amount that is the appropriate, that says something about the valuation company itself. But I think it's also important to read the contract between the client and the valuation company in terms of what it is the valuation company has agreed to do. Because sometimes it ends up they have agreed only to value certain assets, not to actually perform the purchase price allocation itself. Mm-hmm. And there's a world of difference between the quality of the product that comes back from a valuation company in terms of the valuation of individual assets and a completed purchase price allocation, because the completed purchase price allocation valuation is a much more significant product than merely the audit or the valuation of like the intangibles and the fixed assets. That need to be. Now, this often occurs, as I understand it, because the evaluation company won't do the purchase price allocation service unless the underlying data is audited, and sometimes it's not audited. And so in terms of the client's ability to do a purchase price allocation themselves, I think it's especially critical that everybody understands what it is the valuation company is going to do and what ends up still needing to be done by the client. Mm-hmm.
You know, we're going to spend a little bit more time later on the topic of using the work of a specialist. Mm-hmm. But I know the first thing that comes to mind is when we look at that issue, we generally look at it in terms of the quals, and the issue of objectivity is something that we'll touch on that becomes even more critical again in these smaller company settings.
Another thing, for business valuation purposes, there's a couple of different accreditation types of groups. I think one is one within the AICPA, and then there's another one outside. Mm-hmm. So there are some accreditations that you can look at for business valuations. I wouldn't necessarily hang my hat entirely on that. I would try and get some other valuations that that individual or group has performed, and so I get a feel for the quality of the work that they're doing. It's not an easy thing, but I think there are a couple of accreditation groups out there that will help to some degree.
Well, yes, and your own experience with them will also. We are fortunate enough to have some valuation folks within the firm that participate with us as members of the audit team, not performing the evaluations for our clients, but performing as members of the audit team to help us to assess the quality of the work product done by the outside valuation company. And their advice is invaluable to us. So it's something I do recommend that an auditing firm have a good, solid contact that it uses to consult with on audits in exactly this way if they don't have someone internal.
Very good advice.
I think that's all we had for business combinations.
Okay.
Impairment really is on the next slide, slide 15. We kind of touched on that a little bit when we were talking about business combinations and if there was a significant intangible, be it goodwill or other sorts of intangibles. But any long-lived assets need to be periodically evaluated for impairment. We've seen a number of issues related to the impairment evaluation. Back once again to the business combinations, if you have that impairment that is incurred shortly after the business combination, I think you need to really evaluate whether the goodwill really existed to begin with. There's a paragraph in 142, I think it is, that says that if you've had an immediate write-off, that raises the fact that perhaps maybe you didn't have an asset to begin with that you should have recorded. Now, certainly there could have been something that occurred during the acquisition date and year end that could have caused that impairment, but I think that's got to be pretty dramatic, and particularly if you're going to write off substantially all of the intangible that you just shortly or just earlier recorded. So you're going to have to do a substantial amount of audit work if there is this impairment to determine whether the purchase price should have been set lower to begin with. That having been said, then there's other just impairment issues that you go through on an annual basis to evaluate the impairment of long-lived assets. At times, there's no corroboration at all, no audit testing of management's assertion that no impairment exists, even though there's some indication that perhaps impairment exists. There's no revenue being generated from that particular asset for the last year, and none even in the first quarter. There are continuing operating losses that the company is incurring, indicating perhaps there's been an impairment of some of these long-lived assets. So you have some of these indicators, but yet there's no audit work done to verify management's assertion that there's been no impairment. In other cases, they will go through an impairment analysis and do maybe a projected cash flow, future cash flow. Well, the trouble in some of those that we've seen is that sales have increased 1,000-fold over what they were in the prior year, and they just didn't make sense. And yet there was no audit work done on those assumptions to determine that those were in fact reasonable and should be relied upon. I think the last two bullets are kind of those two things. The last one is they actually recorded an impairment charge, but again, you've still got to do the same testing to make sure that the assumptions that they use to calculate that impairment charge is reasonable.
Curtis?
Challenge here is that it's usually pretty obvious. This isn't one of those areas where it's so difficult to identify. I mean, you can see the signals coming. The problem is that when the client is starting to have a problem with recoverability of assets, now what you want to do is tell them, okay, now we all see it. Now let's spend some more time and money and get to the point of where we figure out just how bad it is. And that becomes a rub. I mean, it's offensive. And if you're finding it late in the game, the quality of the information that you're going to get back, the ability to assess it, the ability to help your client understand what the issue is, it becomes quite difficult. We've seen the same thing. This is similar. We're going to talk a little bit about going concern considerations. Immediately, the cash flows that the client is providing to you almost always initially recover the value of the asset to start with, and then you have to start working it and say, okay, historically, what has occurred here? Is this reasonable? Can we look at this recoverability as something that will actually occur? And you don't have the crystal ball, but you've got to have the adequate evidence to make it make sense.
Sounds like a good topic for a planning meeting.
It does.
I wanted to mention there's just one other topic, and that is in this area discerning the cash flows attributable to that asset. It's a difficult task at times on a larger, more complex entity. There are a number of tools out there. We use tools, research tools, RIA Checkpoint, I think it's CCAH's, the Accounting Research Manager. The number of the firms have tools available for interpretations around this literature, and you'll find those to be very helpful in trying to understand how to apply that literature and discern those cash flows.
Let's move on to slide 16 and talk about going concern considerations.
Okay. Basically, the auditor's responsibility here is to evaluate whether there is a substantial doubt about the entity's ability to continue as a going concern. What we've seen in a number of cases that even though there are indicators that a going concern opinion should be evaluated, recurring losses, current assets are far lower than the current liability, so there's negative working capital to a significant degree. In some cases, we've actually read through the 10K, and management indicates that the ability of the entity to continue is suspect. And yet, you read that, and there's no going concern opinion and no evaluation as to whether there should be a going concern opinion. In other cases, there's going to be, again, a cash flow that's done to show that the entity can, in fact, survive for the next 12 months. But again, no testing of the assumptions that were used, and in some cases, those are just totally unreasonable. So you need to make sure that those assumptions make sense and are reasonable, and you need to audit those.
Curtis, Joanne?
Other thoughts?
No, it's only with respect to the emerging company, I perhaps would suggest that it's sort of default to there's probably most likely a going concern unless they can prove otherwise. But
Well, certainly from a liability perspective for the firm, I would certainly agree with you.
Well, it's just a question that arises probably for most emerging companies, just to be sure, because you don't know.
There is that challenge. There is no obligation on the part of the auditor to predict the future. You do not have to have a crystal ball. You do not have to get it right. And the very fact that there's a failure within the 12 months is not an indication that there is a gas failure. But if the warning signs were there and there was no analysis, no evidence, you'll have to assume that it was just simply missed.
Yeah.
So, yes, there's always a concern. It's an emphasis of a matter, paragraph, an opinion. And there's always a concern that it's a self-fulfilling prophecy. But just to ask the question and to analyze it within your audit work does not necessarily get you to that additional opinion paragraph. So why not take the time and do the analysis?
Well, this seems like a good point to take a break. So we're going to take about a 5-minute break and then return to the formal program. So as I mentioned during the opening comments, the revised CPE standards adopted by the state boards of accountancy require us to take attendance during today's presentation. This means that all CPAs should write down the individual CPE program codes we give out during each hour of the program and keep them with your program materials. And later on in the program, we'll tell you what to do with that information. As a reminder for our California CPAs, you should also be on the lookout for those CPE pop-ups that appear frequently during the program. So let's take our short break, mark the time on your watch, and we'll see you back here in 5 minutes. Okay, we're back, and thank you all for coming back. We've had a couple of questions that came in during the break that relate to some of the discussion that we had prior to break, and I thought we'd take a moment or two to ask those questions and get your input before we move on with our slides. And so we had two questions with respect to revenue. One of them was having to do with companies that are in development stage, particular maybe development stage mining companies, things like that, where revenue is not relevant yet. Perhaps there's not a lot of revenue yet. How to go about handling that? Does the balance sheet work there? I mean, give us some insight into what the PCAOB's expectations would be, and then how the auditors would deal with that.
Well, I think in any circumstance, you first evaluate whether revenue is a significant item, and if it is, then obviously you've got to do more audit work. In a development stage, typically the revenue is very minimal, and so there's not a lot of audit work that needs to be done around revenue. So probably a balance sheet approach is appropriate. I'm going to hedge that, though, to say that just because the recorded revenue is not significant or immaterial doesn't necessarily mean that what should have been recorded is not. So I think you still have to understand the revenue recognition policies of the entity, how they're recording revenue, and evaluate whether they have properly recorded revenue. So I think those are appropriate. Obviously, if you deem those immaterial early on, the less work that you're going to need to do. But I still think you need to evaluate that.
I agree.
The other thing to be concerned about is those early on transactions may set a precedent for how larger transactions are recorded in the future. So the early on ones may be ones you really want to pay attention to. But in general, I think I would agree. If the revenue is not material, then the focus on the balance sheet is probably where you should be. I'll bet the expenses are material, though.
Yeah.
We've also had a couple of questions about going concerns. In quarterly reporting, how to address going concern issues that didn't exist or weren't addressed at year end?
You know, it is possible, it's been my experience, that you may have a situation that develops after year end where an emphasis of matter paragraph was not necessary, but let's say the second quarter comes along, transactions take place, and it is now necessary. And while we don't usually issue review reports on a quarterly basis, you can issue that review report, and if that 10Q is referenced into a 33 Act filing, it could also be accompanied by not a consent letter, if you will, but rather an acknowledgement letter. And again, those research services that I referred to have references to those types of letters and have examples of those.
Anything else that you'd like to add with respect to that particular
so.
topic? No. Okay. Well, then let's move on to slide 17. I believe we're on loans and accounts receivable.
We are. The general responsibilities, there's two that are listed there, and I'm going to kind of work those into basically when I'm talking about the inspection observation. The first one was there is a presumption that you are going to confirm accounts receivable. We have found a number of cases where there was no confirmation of accounts receivable, nor was there any discussion or documentation as to why accounts receivable confirmation is not appropriate. It can be appropriate not to send confirmations out, but you need to make sure you document that if that's the case. The second one really applies to the testing of the allowance for loan loss or the bad debt allowance, whichever one you want to say. That they both kind of fit together, and I'll talk about them both at the same time. Typically, when your management goes through to calculate what the loan loss or the bad debt reserve is, they'll go through and categorize the different types of receivables, the different types of loans. For example, in the healthcare industry, you'll take the receivables and classify them between Medicare, patient pay, insurance, etc., and then we'll bucket those to calculate your bad debt reserve. The same thing happens in the allowance for loan loss. You'll take the loans and categorize them between real estate loans, commercial loans, consumer loans, etc. Then you'll further categorize those between those that are current, those that are 30 days past due, or you categorize them based on their substandard or other terms that are used in the finance industry. Then after having categorized those, then you apply certain rates to each of those categories of loans to calculate either the bad debt reserve or the loan loss reserve. What we're seeing is that there's limited or no testing of the categorization of those loans, the bucketing of those within the categories, of whether they're current or 30 days past due or et cetera. And further, there's no testing of the rates that are being used to apply to those different categories. So it's a myriad of things that the firms are not testing, and it's basically in management's computation of the bad debt reserve. Let me see if there's anything else. I think that probably covers the major things that we saw in accounts. Well, no, there is some other things. In the confirmation of accounts receivable, we saw a number of cases where there was no follow-up by the firms on the non-replies, no alternate verification work. They had decided that it was critical to their audit plan to send these confirmations out, yet when they didn't get a reply back, they chose not to do any additional work. We also saw a number of cases where there were exceptions that were identified on those confirmations, and no follow-up was done to determine how those exceptions really impacted the balance or the audit plan. So if you have those confirmations you're sending out, make sure that you do alternate verification work, not just do some subsequent receipts testing. You really need to do some alternate verification work on that specific receivable balance.
Well, as an added incentive to really tempt the engagement teams to do that alternative work, just consider some of the things you might find out from doing it as sort of a byproduct of the receivable work, which is there could be customer exceptions that indicate the existence of a side agreement that wasn't in the contract, the written contract between the client.
Again.
And it's going to kick in something else on another process. There's all sorts of things that you can find out from exception follow-up other than just, hey, I'm just finishing the audit of receivables. So exciting things in there in the exceptions, you know. So go get them.
I think there's a possibility that if you're taking an analytic review approach to the balance sheet or to the income statement, auditing the balance sheet and then not confirming the receivables, there's a good chance you're probably going to miss about 4 out of the 5 assertions for both of those counts, whether it's on the balance sheet or going through the income statement. We have certainly found where the basis for the allowance is calculated off of a schedule, which is based upon Excel spreadsheets that's been provided with historical data, and what you come to find out, though, is that the payments are not being attributed to the appropriate invoices, and the aging always looks pretty good because the older invoices are what's being taken out first by the payments, and you need to understand the nature of those transactions and whether those receipts are actually being tracked to the appropriate invoices. So that underlying data, that aging analysis, is something that quite often isn't audited at a level that it needs to be in order to get a basis for that allowance.
Shall we move on to our next category on
Let's
slide
do.
18?
Slide 18, the use of service organizations. There's basically 3 common problems that we run into in the use of service organizations, and it fits into 1 of 3 buckets. One is that the service organization, what they're testing, really doesn't match with what you want to have, what control you want to test. For example, we see them a lot in employee benefit plans and banks handling their investments. Well, if you get a service auditor's report that addresses valuation and you are looking for existence, it doesn't matter that you got a service organization report. It's not helpful. The second was in most of these service auditor report, there are user controls that must be in place at the user organization and operating effectively for you to be able to rely on the service auditor's work. There's no evaluation by the audit firm of those user controls and no testing of the user controls to make sure that they're operating effectively. And the third, and probably the most common problem that we see, is the timing of the service auditor's report. And I know that's a big problem because they don't all necessarily have 12/31 cutoffs for their service auditor's report, even though your client is a 12/31 year end. But it needs to cover the period that the audit covers. And if it doesn't cover that period, you need to evaluate what additional work, what other substantive work you need to do in that stub period, that interim period, after the date of the service auditor's report before the year end of the client. It can be varied and will depend on the length of time between the service auditor's report and year end, and also what sort of changes that have occurred. But I think Joanne and Curtis will both talk about, they have a fair amount of use of these, and they'll talk about testing that stub period and how their firms go about evaluating that.
Why don't you go ahead?
Okay. These SAS 70 reports, as they're commonly referred to, I just want to make this initial comment. Just because a SAS 70 report is produced by a service organization does not mean you need to get a copy of it, doesn't mean it's of any value to you. And yes, we have seen some circumstances where there was a SAS 70 report just neatly tucked into the work papers and labeled, but just there was no reference to the reporting process that we were dealing with, no reference to the controls that were being tested, just no connection whatsoever. And I'm sure you've seen some pretty interesting stories around that, Mark. There's a number of resources, by the way, let me make you all aware of these, that you could turn to for understanding how to utilize a SAS 70 report. And I got to remind myself, but in the appendix to the PCAOB Audit Standard Number 5, there's some great descriptors in there of SAS 70 reports, how to utilize those. And it's some, good, straightforward language that you can utilize not only on your issuer clients, but your non-issuer clients when you need to consider that. There's also in the AICPA Audit Guide for service organizations, I guess it's in Chapter 3, there's reference to Type 1 and Type 2 reports. And again, some very good explanations as to the nature of those reports and how to utilize those. And then finally, Mark, you made reference to the employee benefit plan area. There's a checklist that comes out of the Audit Quality Center for Employee Benefit Plans that is a very useful tool for utilizing SAS 70 reports. So even if it's not an employee benefit plan that you're utilizing the report for, it gives you a good understanding of how to use that, what the nature of it is, what's the difference between a Type 1 and a Type 2, and help you to address some of these questions about timing. I don't know, Joanne, you want to touch on the topic of timing?
Well, I believe the important thing to do is sort of break engagement teams out of their pattern of getting the report and filing it and so forth, and not really kind of looking at it, not really integrating it into the audit. So my suggestion really is to have teams like beef up their practice aids a little bit on this, and maybe rather than just having one step in a program dealing with SAS 70, break it up a little bit, give the teams a little bit more direction, what exactly their responsibilities are in SAS 70, and help them out a bit.
We've gotten a question. Does the public company SAS 70 auditor have to be registered with the PCAOB?
No.
No? Okay. That answers that question. I like those answers, Mark. No. Okay. We talked.
Great idea, though.
I don't know. We have enough on our plate right now to handle it.
Write your congressman, everyone.
There'll be a new 4010 report after that. Well, we talked earlier about use of valuation experts and going outside the firm to get experts. What about the use of other auditors, which takes us, I believe, to slide 19?
It does indeed. This one's kind of a twofold question. It first evolves around, there's a section called 543 in the audit standards that talks about principal auditor. And first the firms need to go through and decide if the volume of work that they're auditing, the revenues, the assets, those sorts of things, are not significant into the overall assets, liabilities, and revenues of the entity, then they can't serve as a principal auditor. So there's a screen that you need to go through to make sure that you are in fact the principal auditor. We're seeing a fair number of problems in this circumstance where there was a shell company, the principal auditor of the shell company had been the auditor. Then there was a reverse merger that was done, so all of the operations, literally all of the assets and liabilities are now in the non-public operating company that now are in the consolidated group. The non-public operating company was being audited by another auditor, whether that's domestic or foreign, and we're seeing a fair number of foreign types of reverse mergers now. But if that auditor of the operating company, you can't use that as your own work, then you're not going to be the principal auditor because you've not audited anywhere close to a significant amount of the total consolidated assets, liabilities, and revenues. So if you get in that circumstance, you need to make sure that you evaluate whether you are in fact a principal auditor. Now, one of the things that you can do is to make sure that you are the principal auditor, even though it's the bulk of the assets or a significant amount of the assets, liabilities, and revenues are being audited by somebody else, is to go through the same planning, supervision, and review types of standards that you do for your own staff people, and you actually perform that on this other firm. I've seen people actually send over their audit programs. They've got involved in the planning sessions. They've got involved in the discussions with management, addressing the audit risks. They had people in the field supervising this other firm, its audit work, wrote review points, those sorts of things. The further you get away from that sort of involvement in the planning, supervision, and review, the further away that you're going to be from being the principal auditor. To the extent that we've actually seen some work papers that were in a foreign language that the principal auditor neither read nor understood. So I don't know how you can say that a Chinese audit report, I can now put my opinion on the consolidated group when all the assets, liabilities, and revenues and expenses are from this other entity.
It's a good point. And it's important also to know that once you've determined that you can be the principal auditor, that is not a decision that lives forever. Things change over time. And I believe the principal auditor, especially the principal auditor of a company that's growing and growing into far-flung operations, the principal auditor needs to reassess, at least annually, whether or not they can still be the principal auditor if indeed the growth on the international side, which are audited by other auditors, is increasing much more quickly than on the domestic side, because you're the principal auditor but auditing a shrinking percentage of the company. And what you want to do is think it through and say, what can I add to the mix in terms of adding on audit procedures to start exerting some control, some review over the work being done by the international auditing firm so that I can continue to be the principal auditor. And as you see the growth beginning, that would be the time to start planning on gradually adding those procedures to move along with your declining percentage.
Do I recall correctly, Mark, it's audit standard number 3 has some very specific requirements about, I'm recalling a phrase of you need to obtain, review, and retain work papers relative to other auditors. So if folks aren't...
It's 3, but it's in there somewhere.
Yeah, that's right. I'm with Joanne. I don't know exactly. It's in there somewhere, but I don't recall exactly where it's at either.
Again, in the real estate industry, you deal a lot with other auditors.
You probably would.
We have some public funds where we have 500 investments and 100 other auditors out there. So it gets to be a pretty cumbersome task to sort out where everybody's at and who's the principal auditor. And
that would be really unique for your...
Yeah. Yes. It's been challenging. It's been fun.
That's true.
Another tool that's out there, by the way, that I think, if I recall, in June 2005, the SEC Regs Committee, which I mentioned earlier that I'm a volunteer on, put out a matrix that helps you to understand the reporting in these various scenarios when PCAOB opinions are required and when they are not, when you have other auditor situations, and that's a pretty handy tool to refer to. So I believe it was June 2005 when that was promulgated.
We've gotten a question about the responsibilities of the principal auditor with respect to work done by an equity investees auditor. Any insights there to offer?
Interesting question. I suppose what they're talking about is the issuer is accounting for an equity investment, and that equity investment is audited by somebody else. I guess part of my decision would be based on how significant is that equity investment to the balance sheet and income statement of the issuer. If it were minimal, I would think there'd be very little involvement. If it were the only asset or only asset that this issuer had, I would say my involvement would have to be increased dramatically, almost to the point where, absent being really involved, I'm not sure that I could be the principal auditor. Obviously, that's a judgment call, but what do you guys think?
Well, they might be asking a question that goes a little bit beyond the principal auditor question, which is, do you need to refer to them in your report if you're going to rely on the auditor's report? And I think the answer is yes to that. If the equity method investment is significant to the issuer, and another auditor audited the equity investment, I believe if you were going to not rely, or if you're going to, Oh, yes, if you're going to rely on their report, you would indeed put that in the auditor's report.
That's a situation that we deal with pretty commonly, and that's where this matrix will help you to understand the type of report, by the way. If you do refer, you must receive a PCAOB standards opinion. That is the type of opinion that you'll have to have included. And the auditing standards you referred to specifically refers to the equity method investee scenario as being one in which you would evaluate the principal auditor, other auditor circumstance. Specifically refers to it.
Okay.
What about the use of the work of specialists on slide 20?
Slide
We touched
20.
on it earlier, but let's delve a little deeper.
We did touch on the work of specialists earlier, and part of the things that we talked about was evaluating the qualifications of the specialist, and that is a difficult area. In some cases, in others, it's the specialist is well-known, well-respected in the industry. They do dozens of these, and so in some cases it's very easy to determine the qualifications. In others, probably the more specific the valuation or the use of the specialist is, the more difficult it might be to evaluate the professional qualifications. The second thing, and probably the one that we run into problems the most, is that in most cases where a specialist is involved, there's information that's provided to the specialist that they use to come up with their report, whether it's oil and gas production information, whether it's sales information, whether it's whatever. There's information that's being provided typically by the issuer to the specialist that they're using as a basis for their report. They also use different assumptions to go through and calculate what they believe the valuation, if you will, or other results are. The auditor needs to evaluate those assumptions to make sure that they're reasonable. And second, they need to test the information that's being used by the valuation expert or specialist to come up with their report, to make sure that that information is accurate. Otherwise, the report that the specialist has is not going to be accurate. So.
Yeah, I mentioned earlier the issue of when we think about assessing the specialist, we think quite often about the quals. And that's very easy. Send me over all the acronyms that go after your last name so I understand that you're of value. But the objective nature, especially again for these smaller companies where, you know, the private equity or VC specialist that's sitting on the board just gave you the value of the securities that were issued, the more, I guess the way I would look at it is the more subjective the issue, the more objective you'd like to see the valuation specialist or the specialist that you're looking to. So you need to consider that. There is a technical practice aid that I'm aware of that talks about the level of quality of a specialist's work. It talks about whether it's contemporaneous and unrelated, retrospective and unrelated, or contemporaneous or retrospective but related. Those being from the best to last, if you will, of the qualities of assessing a specialist. So there's a great deal of guidance in that technical practice aid, which would be of value in trying to assess the quality of that specialist and their work and how much you can rely upon it. I suppose it's only in the largest of transactions where you see the audit firm has hired a specialist to audit over the work of the specialist that the company hired, but you can certainly get to that extreme. I've certainly worked in those environments. It's less likely to occur in the smaller company environment, but you can take it to that extreme, and it's needed.
Now, the one human nature aspect to using a specialist that an auditor has to work hard to overcome is you get this nice, shiny, bright cover report, and it just looks so polished, and it looks so nice and complete. You say, here's something, I can just look at the numbers there, check them off, they've been recorded, and I'm done. And, Mark and Curtis both referred to the need to test the underlying data and the assumptions. And also, I have talked earlier about the need to understand the accounting if it's indeed one of these reports on the valuation of derivatives and all this kind of stuff. It is so critical to stay very involved in that product and to make sure you understand the workings of the assumptions, the workings of the calculations. And if you do need to bring in some expertise from the outside to help you through that, that's an important thing to do because you must understand.
Mark, on to slide 21.
All right, independence. We probably get more questions at the small firm forums on independence than probably any others. Some of the common problems that we ran into during the inspections revolve around the preparation of financial statements and footnotes. There are a number of firms that are doing that. Primarily, they say that the issuer had nobody with the expertise in-house to prepare those, and so if they didn't do it, it wasn't going to be done, and it wasn't going to get done timely or accurately. So they've, in essence, prepared those financial statements and footnotes. That's a no-no. Unfortunately, the SEC has different rules than the AICPA, which Curtis has talked about on a couple of different occasions, but you must be aware of those SEC independence rules, and you cannot prepare the financial statements or the footnotes. Now, there's always lots of questions, well, what if I just did this or what if I just did that? I'll try and answer a few of those and throw some examples out. We see frequently that the only footnote they prepared was the income tax footnote, and because the issuer, again, didn't have the expertise on board to do the deferred tax asset and liability computations. If you do those computations and you can prepare the footnote, that's forbidden. You're not auditing your own. You're auditing your own work then, which is forbidden. So you've got to make sure that the issuer goes through and does that tax accrual and prepares that footnote. Then I've had questions from the audience. Well, the issuer goes through and books a flat amount for the tax expense, 35%. That's the combined rate, so they just book that. So I just go through and prepare an adjustment to go through, but they have to go through and calculate what all the deferred assets and liabilities and change therein is. But they said, but that's not material. I'm sorry, when you're doing that computation, the issuer doesn't have the expertise to do anything other than book a flat 35%. I believe that you've prepared those footnotes and you're auditing your own work. We've also had questions about the cash flow statement. Well, what if I just send them over a template and let them fill out the cash flow statement? Well, you really have to evaluate whether embedded in that cash flow Excel spreadsheet is the decision on what should be classified as operating, financing, and investing. And if you've got those embedded in those formulas where the issuer just drops in the numbers and then it calculates what those are, I think that you've also prepared the cash flow statement. So in my mind, keep in mind the general rule that you can't audit your own work and don't do that. The rest of them that we go through then about preparing bookkeeping services and others we don't run into quite as often, but on occasion you'll run into people where the issuer really didn't have any books, and so I've made journal entries to record every transaction. Well, I hate you're not preparing adjusting journal entries, you're preparing the books of record. So you can play games and tell me that those are adjusting journal entries, but if you get to the point where you're actually creating the accounting records, you're violating the independence rules.
Yeah, this one is so hard for smaller accounting firms, because the smaller accounting firms really grew their businesses from a desire to be helpful to their clients, and it is their nature. However, times have changed, and we are no longer allowed to help our clients in the process of closing their books and preparing their financial statements. It isn't easy, though, to watch your clients suffer through a close, especially. It's just not easy to watch that, given who a lot of us are in the accounting firms. However, it is the client's responsibility to have sufficient resources to be able to close their books and prepare their financial statements. And as a matter of discipline, we need to bring discipline to the process, and we need to embrace this and tell our clients no. And it's just hard to do, but it's something we must do.
Mm-hmm. The matrix that I referred to earlier that the SEC Regs Committee put out in June of 2005, if nothing else, it'll help you to raise a lot of questions about the independent side, because it doesn't really answer those, but it does tell you, like I said, when a PCAOB opinion is required, et cetera. There's also a great tool that the AICPA has produced, and it is a comparison of the AICPA SEC independence rules. So it lays those out side by side. And I believe there is also one in there that includes the GAO. So you can take a look at that. Just to warn everybody, there's also some unique rules relative to benefit plans that the DOL has as well. So just something to keep in mind depending on the nature of the client that you're reporting on. But that comparison between AICPA and SEC is pretty helpful.
And Mark, where would a person go within the PCAOB to get to answer questions about independence?
The best place to call is standards, our standards division, and probably one of two people within the standards division. Bella's going to hate me for this, but Bella
phone numbers too?
I don't have Bella's phone number, but Bella or Greg Skates, either one.
And what's Bella's last name?
Rifskin.
Okay.
Probably didn't say that right. Bella, I'm sorry.
Rifshin.
So, but standards is the place to go
It
with
is.
the PCAOB, and I'm sure you can find that contact information on the PCAOB's website. We had one other quick question about this particular slide, and that is with respect to the auditor being prohibited from providing bookkeeping and other services relating to financial statements that form the basis of financial statements filed with the SEC. Can you give us a little more clarity about the forming the basis of? That's where the confusion was from one of our
I will tell you, I've had a particular experience with that, and I think the question that we were talking about earlier regarding the equity method investee might be one in which you have the financial statements of the issuer as an investor are an investment in and an equity pickup. However, the equity method investee may be an operating entity which has revenues and expenses, has assets and liabilities, all associated with the transactions that are taking place at that operating entity, none of which is going to be reflected other than in a summarized footnote disclosure in the issuer's financial statements. So there I would wonder, do those financial statements, while the equity pickup is important to the issuer, those financial statements are not dictating or form the basis of the financial statements of the issuer itself. So that might be a good example.
what that means.
Probably the parent-sub relationship would also be another one, where you paired the subs financial statements that then roll up into the financial statements that are filed with the SEC. That's another situation where that can come into play.
Okay. Getting back to Joanne's point about being helpful to clients, we have a question about whether or not the auditor can help teach their clients. So where do you run into that independence issue if you are helping your client learn? Kind of obviously you're not going to catch a fish for your client, but can you teach them how to fish?
Yes and no. And we've had this question come up in the small firm forums, and our standards people have tried to address that. So I'm going to try and paraphrase what I've picked up from there. You can certainly try and help your client, educate your client, but if it comes down to the point where you don't believe they have internally the expertise to do whatever it is, whether it's prepare that deferred tax footnote, for example. You've tried to educate them, but you don't believe that they have the expertise, and so you end up doing that. You've crossed the line. So it's a fine line that you've got to make sure that they have the technical expertise internally to be able to handle whatever issue it is that you're talking about.
That isn't to say that you can't send them examples of how others have done it from other filings, or textbooks, or whatever. It's just you can't really send them anything that would do it for them, in essence.
Yeah, again, there are all types of research tools out there that your clients most likely won't have a need for, but which you as a firm probably have access to. And getting examples over to them, I think, would be most appropriate.
We've gotten a lot more questions about independence.
Surprise, surprise.
I know, but I do want to move on to indemnification, slide 22. I do want to make sure that we'll get through this. We will have time at the end for questions, so hopefully we can circle back and get some of these other questions.
Is that a clue to kind of speed up too, Cindy? Is that what you're telling me?
No, I just want to make sure we cover all 11 of our topics.
Well, we will speed up a little bit on indemnification clauses. We still are running into, on occasion, indemnification clauses that are prohibited by the SEC that are included in engagement letters for public issuer clients. I think by and large it happens in one or two circumstances. One, the firm has two sets of engagement letters, one for their public clients, one for their non-public clients. their non-public clients include an indemnification clause, which is perfectly acceptable for their non-public clients. They inadvertently pull that one out of the file, prepare that engagement letter, send it out, and by doing so, they violated the SEC independence rules. We've also seen in other cases where there's groups of firms that are having these indemnification clauses, and it appears that they've been to some seminar or some meeting that it was suggested they use these indemnification clauses, and they didn't dive into it deep enough to determine whether for their SEC clients it was a violated indemnification clause. There are some indemnification wordings that you can put in, but I'm not an attorney, and I'm not going to try and tell you what is and is not proper. I think if you're going to have one of those in your public client engagement letters, you really need to have your SEC attorney look at that, or at least that would be my suggestion. Remember, that's my opinion only and not anybody else's. But I certainly would have an attorney, a very good SEC attorney, look at that language.
Well, that's not an area where you want to get crosswise.
Well, you know, we have such a fear of that indemnification clause that we don't even use it for our privately held, because we just don't want to take a chance of it slipping in.
We do use it. We do use it on the private company side, and then on the public side, just make sure it gets removed. You know, a good starting point if you wanted to study this and you're interested in having these clauses in and the differences, again, this is recollection, but I think it was a January 2006 PCAOB SAG meeting where the agenda, one of the topics was indemnification clauses, and those agendas quite often, if you've never looked at them, are just terrific, because there will be a number of white papers that are written that are pulled together around the agenda topics, and that's where I went to study this topic to begin with a couple years ago. And it was great information about the views of the SEC, the AICPA. There's an intergovernmental agency that's taken a look at this as well. So that's a great resource to turn to.
And those agendas are on the PCAOB's website. So let me jump in here before we move on to our next slide and tell our viewers that we're putting up the second CPE code. Again, everyone who wants to claim CPE credit in all jurisdictions should write this code down and keep it with you. And we will tell you at the end of the broadcast what to do with that code. And so that code is ALLN406. Again, ALL4N06. I may have inverted that, so let me say it one more time. ALL4N06. So mark that down, and we'll tell you at the end of the broadcast what to do with that. Okay, on to slide 23.
Slide 23, independence policies. There's a couple of areas that trip up a number of firms. One of them really has to do, and it's probably a lot more frequent than the other, is the communication of independence with the audit committee. We're seeing a fair number of firms that they just miss that. That's an oversight on their part. It's really easy to cure, so and one of the firms in a number of the small firm forums said, well, can I just put that in my engagement letter so that I don't forget? That's certainly acceptable. There's no prescribed way that you do it. It just has to be in writing. So putting it in your engagement letter is probably not a bad idea. The other area, there's a number of independence rules that the firms have to comply with, and that is that they need to, on an annual basis, confirm independence with all of their company personnel. 2, they need to maintain what I call a restricted entity list, and that is a list of all of their public clients. 3 is on some sort of test basis, they need to test the representations of both their partners and managers regarding the investment in their publicly held client base. It seemed like there's a third. Oh, you need to have independence training. So those 4, and probably the verifying the representations of the partners and managers is probably the most frequent of those that we see.
Insights there?
When the rule first came out in terms of testing the accuracy and completeness of the personal investment information, it threw many firms into a bit of a tizzy as we were starting to draft up policies where we were going to test check, you know, the representations of our partners in terms of what they owned and so forth and so on, and getting their tax returns and getting copies of their
Brokerage statements.
their brokerage statements and all that kind of stuff, and test checking it all around. And it was going to be a big deal because it was some place we had never gone before. And so we were consulting with other firms, and what seemed to be going on for firms that didn't have a lot of issuers in their client base was that if we got the stockholder listings from our publicly held clients, and they didn't have a lot of street name type holdings on them, that we could check the stockholder listings, and as long as we didn't have partners, managers, and the like listed as owners of company stock, that was deemed to be a sufficient control in this area, rather than test checking the partners' personal assertions each year as we confirmed their independence.
We mentioned checking their brokerage statements. Are there alternative ways to test and audit their personal transactions, partners' personal transactions?
Well, as Joanne just mentioned, some of the small firms will get a listing from the stock transfer agent, all the stock held in those by that issuer client, and so you can review those as well. I've also seen on rare occasion, I haven't seen it very often, where the firm hires an outsider, typically an attorney, then the partners and managers send copies of their broker statements and tax returns to this outside attorney. He then has a list of their publicly held clients, compares the two to make sure that there's no prohibited investments. So those are the two that I've seen, getting the stock transfer list from the stock transfer agent and using an outsider. There's probably other ways, but those are the two that I'm aware of.
That outside resource sounds like a great solution, because you have the concern about who's going to know who actually wants that information.
Well, exactly. So at least you could presumably assert privilege if it was an attorney. Okay, I think that brings us then to slide 24.
The last slide.
To talk about concurring partner review, our last category that was identified in the 4010 report.
All right. The first bullet there talks about the scope of the concurring partner review. A couple of things that I want to mention here. In some cases, we actually found where there was no written evidence of a concurring partner review actually being done. The firm said that they did one, but there's no checklist, there's no sign-offs, there's nothing to indicate that a concurring partner review had been performed. Second, when we talked about scope, we're seeing in some cases where the concurring partner review is very minimalistic. Maybe they do nothing more than do a high-spot read of the financial statements and footnotes. They don't get involved at all in the planning. They don't review any of the significant audit risk areas, the work papers themselves, to see that the work was done properly, supported the opinion. So scope can be an issue if you're not having a proper concurring partner review being done. The timeliness, we've actually had some where the concurring partner review was done after the 10K was filed. Doesn't do you a lot of good if you're not doing that on a timely basis and making sure that the points that were raised by that concurring partner get cleared prior to the time that the 10K gets filed as well. And third, having to do with the qualification, a couple of things here. If it is a specialized industry, I think you really, as a firm, really need to be looking to see that the concurring reviewer has that experience and expertise in that specialized industry. If you've got a financial institution that you're having a concurring partner look at that's never done a financial institution, it's not really going to be a very worthwhile concurring partner review. So one, make sure that they have that. We've also seen where the firms didn't have audit partners, and so they've actually had tax partners go through and do the concurring partner review. Again, it's that same experience, only now it's not specialized industry, it's just basic audit experience. So make sure that the concurring partner is properly qualified to do the review.
Does he or she have to be an equity partner?
They have to be a partner, and there's so many different ownership structures now, and I think we were talking about that earlier, and I think Curtis said that they actually looked at that in relation with their peer review, and I've forgotten now exactly what he said, and maybe he ought to really answer this rather than me, but I thought he said they were subject to the shareholder agreement. So as long as the partner shareholder was subject to the shareholder agreement, then they were a partner as far as the concurring partner review standards were concerned. Did I get that right?
That's right.
Okay.
That was the determination we came to, yes.
Okay. Any other thoughts on concurring partner review?
Let me suggest something. In a firm that has a limited number of issuer clients, the concurring review concept is a bit foreign because it's primarily embedded in, and specifically required on the public side. One of the things we've done as a firm is we've implemented it on all of our higher risk clients, as we say. And it is not a different type of concurring review. You have some folks say, can we do a concur light? You know, and that's not the case. So what happens is that all of our partners get exposure to a concurring review. Just about every principal in the firm has a higher risk engagement, public or not. So I know it's an idea. As a matter of fact, I believe there's either a proposal in the works that the AICPA, you know, has put forth on the quality control side to suggest this is something that you should implement for the private side as well. But I would suggest using the process. It's very valuable. And the quality control literature by the AICPA specifically lays out what a concurring review is about, what's expected, what the terms are. That you can even from there develop easily a checklist to sign off on. And so you can understand what the concurring review process is. So there's a couple of helpful tools.
I think we have time for one more question that I've received, and then we'll do wrap up. And the question is that the PCAOB literature specifically talks about having 200 issuers or more to test personal transactions. What if you only have 5 issuer clients?
I'm sorry, I'm not
You're not
aware of
familiar
what
with
you're
that?
talking. 200 issuer clients? I'm not aware of any rule that we have that talks about 200. Not to say there's not out there. I'm just not aware of it.
Okay.
Which would make sense, too. I mean, the area that you practice in is the smaller,
Right.
all under 100, right?
Yeah. We did get that specific question, so I just wanted to flag that.
The person, send that email question to either Bella or Greg.
Okay.
And they'll be able to answer that and email an answer back to either you or
Perfect.
the
We will do
question.
that.
Because I'm sorry, that one I don't know anything about.
Okay. Well, we've covered a lot of ground today, very fruitful ground, so I appreciate that. And what I'd like to do, without putting you all on the spot too much, is to ask each of you to summarize 1 or 2 key takeaway points that you think our viewers and listeners should go home with. So we'll start with our regulator, Mark. Or maybe I should go with you last.
Well, that's okay. I just hope that bringing these issues, these common inspection deficiencies to your attention will allow you to focus on those within your own practice, make sure your ship's in order, so to speak, and not fall into any of these common problems that we have. So hopefully you can use this as a tool to help improve your audit practice.
Curtis?
A similar comment, and that is this inspection process, it's a valuable tool for learning. Take advantage of it and allow it to improve and influence all of your practice. We've found that the concurring review process that we've added, we've dramatically changed our independence assessment throughout the firm. So take advantage of that. And again, I'd suggest take advantage of some of these outside resources and call upon them. Have someone that's spent a lot of time in the public arena come in and just take a look over your shoulder. It doesn't take much time to do it.
And Joanne?
And I would strongly encourage the engagement teams to sort of take a look at some of the topics that have been talked about today, and as they're doing planning for their audit engagements, to consider if some of those are things that they should actually be talking about in planning, and then adapt their procedures accordingly and go out and execute well. And that should help to keep them safe and secure.
Okay, excellent advice from all 3 of our panelists. So I hope that all of you have found our webcast entitled PCAOB Insights on Smaller Firm Inspections to answer your questions, and has been useful for you as you go about doing your public company audit practice. I would like to thank my special guests, Mark West, Joanne Wagner, and Curtis Wolf, for joining us today and sharing their insights with us. For those of you who are interested in having your callings learn more about the key issues that we talked about today, we will make this webcast available on the CAQ's website as well as on a CD-ROM. We'll email participants with the details of how to acquire it immediately after today's program. And in that email, we will tell you a few other key things. You will receive a CPE form for today's program. You should print out that form, complete it, which is where you will note today's 2 CPE program codes, then make a copy of that for your own CPE records and either fax or mail the original back to us at the address shown on the form. Your copy of this form is what you'll need to keep to document your CPE credit. And lastly, we'll email to you a link to the online program evaluation. And we do very much encourage you to give us your feedback. We're always trying to make our webcasts better and more helpful to you, and your frank assessments will help us do that. So do take a few moments to complete that online program evaluation. Once again, thanks to all of you for listening, and thanks to our panel of experts. I'm Cindy Fernelli for the Center for Audit Quality, wishing you all a good day. Thank you.